This is Al Brooks, and this is my price action trading course. The current module has to do with trading swings in the middle of the day. Many days have three parts, and there tends to be an opening range, and then a trading range or channel in the middle of the day, and then a trend in either direction at the close of the day. Here's an example. So the opening range this day was small. Trading range in the middle of the day lasted about 4 hours, and then there was some trend resumption in the final 90 minutes. So we had a bull trend, sideways, and then a bull trend. So we have trend resumption into the close. Today I'm talking about this pink area, the middle part of the day. The opening range sometimes can last all the way out here. So sometimes the green box can be very big, the pink box can be small, sometimes the blue box can be small, sometimes it can be big. The different parts of the day can start and end at different times. Here's a day where the opening range was, the opening move, the trend was small, just about 10 bars or so, not even 10 bars. And then we had a trading range for the middle part of the day, and then a trend resumption into the close, and then a trading range after that. So to me, these are the three parts of the day. We had a bear trend, trading range, trend resumption, and then pretty much dead zone after that. Okay, here's an example where we have a bear trend initially, and then a trading range. Instead of resumption of the bear trend into the close, we have a reversal. So when you have that initial trend and then a trading range, it can either lead to trend resumption or a trend reversal, as we have here. Here we had a bear trend and then a bull trend, a weak bull trend in the middle, and then the end of the day ended up with a trading range. So pretty much any combination can develop. So trading trends and trading ranges, you can see the modules on them. There are modules about trading in trading ranges, and then another series of modules on trading different types of trends. And I also have modules about trading the opening range and then trading swings into the close of the day. When does the middle third of the day begin? It's different every day. It's usually around 8:30. The trend in the open usually ends around 8:30, sometimes as early as 7 o'clock, sometimes as late as 10 o'clock. So you're looking for some kind of reversal after the opening range swing. So it might lead to an opposite trend, it might lead to a trading range, and if it does lead to a trading range, often there are big swings within the range, big enough to make swing trades. If the trend continues, if you want to see what to do, you can look at the modules that talk about how to trade trend days. If the middle third of the day becomes a trading range, you can see the modules on, or the module on trading within trading ranges for additional information. Middle third of the day, weak channels, in other words weak trends, are very common. On most days, the middle third of the day is relatively unclear and it does not have a strong trend. There might be a channel, which is a weak trend, or a trading range. That's the most common situation in the middle third of the day. A channel, in other words a weak trend, or a trading range. Usually there's enough movement for a swing trade, but a lot of times there's not, and you're left with scalping or waiting. Alright, so look at this day. We had 3 pushes up on the open, right? You can argue a wedge top, and then we started to enter a trading range, but then we broke out. Alright, we had a strong bear breakout with follow through. So we have a bear breakout and 5 consecutive bear bodies, right? So at this point, somewhere in here, everyone was agreeing that the day was now a bear trend day. Probable bear trend day, you can see the modules on trading bear breakouts and on trading weak and strong bear channels. At this point, we have a bull inside bar, and the market might be trying to reverse. But this is a 5-bar bear spike and I think the market became always in long, either on that breakout bar or within a bar or two after that. So as long as the market is holding below this high, I think it's still always in short. Excuse me, always in short. It's possible that we're reversing up from the low of the day and that this will result in a bull trend day. But right now, I think the odds are it's always in short. Okay, we've got some follow through here, another bear breakout, and another follow through, but a bull inside bar. So this could end up being a failed breakout. Alright, we have a small double bottom and a bull inside bar, but we're still pretty much in a bear channel. We have not had much buying pressure, right? We have not had a strong bull spike. We have not had 5 or 10 bars up breaking the trend line, right? So it's not yet a major trend reversal. So to me, I think this is always in short, and these are bear flags. We have 2 little pushes up here, 1 and 2. We're still below the moving average, so this might be a short. You could also think of it as a triangle, 3 pushes up, 1, 2, 3. So is it a bottom or a bear flag? To me, I think it's always in short, so I assume every attempt to reverse will be a bear flag. So I'd rather short below than look to buy. We got a 2-bar reversal here for a good signal for the triangle short. 3 pushes up, 1, 2, 3, and there's the bottom of the triangle. So I think that's a reasonable short, certainly for a scalp, and you can also do it for a swing. It looks like we're holding below the moving average. So we got a 2-bar reversal here and a triangle. Is this a final flag, and will this reverse up? Well, we got 4 consecutive bear bars here, 2 more here, so 6 out of 7 bars bear bodies. I don't want to buy until I see a strong bull breakout and then some kind of test of the bear low, creating a major trend reversal. To me, we've got a spike down, and it looks like we're making lower lows and lower highs, so this is a bear trend. Yes, there's overlap and there are bull bodies, so you can call it a bear channel, but it's still a bear trend, and I think it's too early to be looking to buy. I would look at every reversal attempt as a possible new bear flag. So we have this 2-bar reversal, and we got a bear inside bar, and we sold off a little bit more. Another bear breakout and good follow through. You can say, well, it's consecutive sell climaxes and we'll get a strong reversal, and we might, but until I see a strong move up, I'm going to assume that this trend will continue forever. I know at some point I'll be wrong, but I'll be right many times in the meantime. So I think it's still too early to look to buy. As far as how to place trades in here, again, you should look at the modules on trading bear trends. This is a strong bear trend, and now this is a channel, so it's a weak bear channel, a weak bear trend, but it's a very tight channel, so it's basically the same as a strong bear trend, even though it's a channel, and a channel by definition is a weak trend, certainly weak compared to a breakout. Alright, so we may be getting a parabolic sell climax here, and we may come all the way back up to the top of the channel, but still I'd like to see a major trend reversal before I look to buy. Any buy at this point is only a scalp. Looking better for the bulls, possible double bottom, 2-bar reversal, but we did not even hit the moving average. So far you can say, well, we broke a trend line. Yeah, but it's only 3 bars up, 4 bars up, not enough buying pressure. Alright, so these bulls are disappointed at this point. So now we're getting another bear triangle. A push up here and then down. A push up here and then down. A push up here. So to me this is another triangle similar to this. So it's a short below. For the bulls, they can say, well, we reversed up here and it's a triangle bottom and it should lead to a reversal. Well, I'll wait until we break strongly above the moving average, and then I'll look to buy a pullback. I'll wait until I see a major trend reversal. Otherwise, I'm going to assume that this trend will continue down forever. Another bear breakout, another 2-bar reversal, another attempt at a bottom. To me, we're trending down. Again, you can look at the modules on how to trade bear channels, weak bear trends, to see specifically how to trade here. Trends are always trying to reverse, but you got to remember the market has inertia. 80% of the reversal attempts will fail. So you got to go with the odds. And in a bear trend, you should be only looking to sell until there's a significant reversal in place. You have to trust your read. If you look at the chart and you say, okay, I know the market cycle, trend or trading range is a trend, and right now it's channeling. So, you know, it's a weaker trend, but it's still a trend, right? So it probably will continue lower. Probably means that you're 60% confident, and you should only be looking to sell, and you should not look to buy until you see a major trend reversal. Here's some examples on how to sell. I mentioned there was a triangle here, you short below the bear bar. Another triangle here, you can short below the bull bar or below the bear bar. Here's a small double top with a bear signal bar, you can take that short. Here we got another breakout and two little pushes up. We went down here and then up, and then down again and then up. So on a smaller time frame, that's a low 2. You can just look at it as an IOI with a bear bar for a short on this 5-minute chart. You should be looking for swing shorts in a bear trend. So if you shorted below this triangle signal bar, your initial stop is above the high of the signal bar. Your entry is over here. If you're going for 2 times your initial risk for taking half off, you would have gotten out over here, and you would take out your final profit going into the close. There were no good reversals all day long, and now we're getting a big sell climax into the close. I would exit above this bull bar. The bears tried to sell off here. Instead, they got a bull bar, and I want to exit before the close. There's a chance we may bounce up into the close, especially since we had such strong buying earlier. The bulls may come back into the close, so I would buy back my shorts above this bull bar. When you find that your protective stop is small, let's say your signal bar is small, don't exit with a profit of only 2 times your risk. You know, everybody has a default risk, right? For example, in the E-mini, currently a 2-point stop and a 2-point target is the minimum for a 60% scalp. So the default risk in the E-mini is 2 points. It would be 20 ticks in the spider. If your signal bar is only 5 ticks tall in the spider, you know, that means your risk is 7 ticks, 1 tick above for the stop, 1 tick below for the entry. And you may decide that, well, it's a pretty good bear trend. I don't want to go for 2 times my actual risk, my 2 times the size of the signal bar. I'll go for 2 times my default risk. My default risk is 20 ticks, so I'll try to exit at 40 ticks. So for example here, okay, your actual risk in this particular instance is 1 tick above the signal bar. Your entry price is 1 tick below. The bar is 8 ticks tall, so your actual risk is only 8 ticks. You normally are willing to risk 20 ticks in the spider. Here you're only risking 8. If you go for 2 times your actual risk, you'd be getting out here. You can see it's a pretty strong bear trend day, and at this point it's a small pullback bear trend day, so it's probably going to go much further. So instead of using 2 times your actual risk, you might use 2 times your default risk. If you normally risk 20 ticks, why not try to get out 2 times that, or 40 ticks, right here. And at that point, move the stop to break even and swing the balance. Here's an example of a possible reversal at the end of the morning trend. The day might become a bull trend day or a trading range. Alright, so we sold off on the morning. We had a double top. Lots of two-sided trading yesterday and today. It's possible this is simply a failed breakout. You can say it's a parabolic wedge. 2 pushes down, 3rd push down. Possible low of the day, right? Right now, this is not, I think, a strong buy signal. We have a bear trend from the open. We started selling off on the open. And we had the double top, and we're selling off again. Okay, but you can draw a channel, right, across these 2 lows, and we're right at the bottom of the channel. So is this breakout the start of a strong bear trend, like a spike in channel, or is it simply a sell vacuum test of the bottom of the channel? And we don't know. at this point. So it might be the low of the day. Not a good looking signal bar. You could take it for a swing long, but right now I think it's really not a reliable buy. Alright, so what happened right here? Let's say you did buy above that bear bar. Excuse me. It's a reversal bar, close above its open, but it has a bare body, so it's not a strong signal bar. You could buy above it. I think it's an aggressive long. You probably would feel pretty good at this point, because for the bears this is a pullback from their breakout to a new low of the day, and instead of having a strong entry bar, they got a doji close. So let's say you took the aggressive buy, 6 consecutive bars down, hoping that it's a sell vacuum test of the bottom of the channel. Okay. Your initial stop is below the low. Since you'll probably lose on the trade, right? The probability is less than 50-50. You have to go for a reward twice your risk. So if you take this trade, your initial risk is below the signal bar. This has to be your initial target. If you're going to have a positive trader's equation and you're taking a trade that only has a 40 to 50% chance of success, you have to go for a reward twice your risk. This is looking pretty good at this point, right? We tried to trigger a low 2 short below here, and we ended up with a bull outside up bar. So at this point it's looking pretty good. So at this point the market may even be always in long. We've had 4 bars without a bear body. You could adjust your risk based upon you could adjust your target based upon actual risk. At this point you could say, well, at this point we're probably always in long. My actual risk was below the low of this bar, so 2 times my actual risk would be somewhere around here. Mathematically, that is acceptable. We had another third attempt by the bears to sell off, but we held above the most recent higher low. So we're forming small higher highs and higher lows. This is a wedge bear flag, 3 attempts down, and we're failing. We're trying to get a bull breakout here, so you could buy above this bar or you could buy that close. Big bull close, big bull bar relatively, closed well above the high of the prior bars and above the moving average. So this could be a breakout that could lead to a measured move up. If it does lead to a measured move up, the measured move would be from the low of the pattern to the high of the breakout point, and that would be right around here, in the general area of your original target based upon 2 times your initial risk. So this may end up being a measuring gap. So if you did buy above the high of this bar, or if you bought that close, your stop is below its low, and you're looking for a measured move up, which is probably more than twice your risk. After every strong bull bar, you trail your stop to below its low. So if you bought above this bar, or if you bought this close, or if you bought down here, at this point your stop would be below that bull bar. And at this point you're thinking the market will get a measured move up. So you probably should keep your original target at 2 times the initial risk, which is around a measured move up. You could use 2 times your actual risk, which would get you out around here. But we have a new projection based upon this being a possible measuring gap, and it's above a projection based on actual risk. So I would use the wider target. Is it time to buy? You're never going to be more than 60% certain, so you can't be paralyzed by the 40% chance of loss, right? And 60% is as good as it gets. So if you see something and you look at it and you say, yeah, the market's probably going to go up, you're a trader, take the trade. Once you think that the market is always in long, you have to get long. You have to buy at least a small position and use the appropriate stop. If the stop is far, then use a small trade a small position. Again, I talk about this in the modules on breakouts and on trading strong trends. Okay, will the middle third of the day be a channel, a bear channel? Will it be a bull channel, or will it be a trading range? At this point, I don't have a channel drawn in here, right? But it is possible that this is simply a bear trend. We're forming lower highs, and lower lows, right? So we are still in a bear trend. Even though we are reversing, right? We are reversing. We are still in a bear trend. So even though the market is probably always in long, it's still a bear trend unless we get above this high. So you could say it's a trading range, it's a bear trend, and it is, and it's an early bull trend, and it is. We need more information to know what ultimately the result will be. Another bull bar, good for the bulls, right? Starting to get consecutive bull bars, always in long. So this is good for the bulls, and there's a pretty good chance, probably better than a 50-50 chance, that we're going to reach our measured move target. Two more bull bars. So now we have 5 consecutive bull bars, a strong bull spike. It could be a buy vacuum test of the top of the channel. Remember, as long as we stay below the prior lower high, it's still arguably a bear trend. But at this point, I think it's always in long, and I'd rather buy pullbacks. I would not be looking to sell. The market reached 2 times the initial risk, and that created this tail here. Probably a lot of traders took profits at 2 times their risk. We have a strong bull spike, only 1 bear bar in the past 8 or 10 bars or so, and we have several relatively big bull bodies. So I would not exit the entire position. I would just take half off and maybe put a stop below the bottom of the spike here or here and swing the rest. We went sideways into a small wedge bull flag, 3 pushes down, 1 and then bull, and then 2, and then inside bar, and then 3. So I think this is a buy signal, or you could try to instead buy above a bull bar here or above here. For the bears, they saw this bear bar as a failed bull breakout. The bulls saw it as simply a pullback from this bull breakout. As a pullback from the breakout, it's a buy above its high, so you could buy again above here. Small pullback, high 1, pullback from this breakout, we broke to a new high, that's a buy. Buy here, another inside bar, another pullback, that's a buy. A possible final flag reversal, it failed, and so now we have a double bottom, that's another buy. When you're holding a position, you always have to be thinking about taking profits at some point. Okay, now we're above yesterday's high. You can draw a channel here and create a parallel, and we're trying to break out of the top of a bull channel. Most attempts to break out of a top of a bull channel fail. So you have to be thinking that this might be a buy climax. In fact, we have consecutive buy climaxes. Every bull trend bar is a buy climax, right? So we have a climax here, we have a stronger one here, and then here, 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 here. So we're starting to get a series of buy climaxes without much of a correction. At some point, we should get 10 bars, 2 legs sideways to down. So if you bought any of these signals, if you bought all of them, you should be thinking about the possibility of taking profits. Another thing, it's a channel, but look what we have in the channel. First of all, leg 1, if you project up, we're right around a leg 2 move, and we've had a low 1, a low 2, a low 3, and if it goes below here, then we have a low 4. Many channels end with low 4s, so another reason why bulls should be thinking about taking profits. So we have several things going on here that could lead to a transition from a channel phase into a trading range phase. A strong bear breakout bar. So we have a failed breakout above yesterday's high, a failed breakout above the top of the channel, and a low 4 short. I think you could get out below that bar, or you can get out on this bear close, or you could get out below that bear bar. It's not good enough for me to take a short. The channel up is too tight. But when I see a sell signal and I'm long and I'm looking to take profits, I'll get out even if the sell signal is not strong enough for me to go short. And this is what followed. Okay, we had a break below the channel, so a break below the trend line, and then a double top bear flag and a lower high major trend reversal. Okay, the minimum objective after the channel was 2 legs sideways to down. We got 1 leg down, 2 legs down. Also, you'd like to see at about 10 bars in it, and we have about 10 bars. We in fact got a third leg down. Remember, it's not, 2 legs is not necessarily the minimum. Excuse me, not necessarily the maximum. It's the minimum that you should expect. And sometimes you get 3 legs, sometimes you get an entire trend. And we're now back into the neighborhood of the bottom of the channel. Remember, channels usually evolve into trading ranges. So when the market's down here, you'll say, yeah, it's a trading range. We went up, we went down. But when the market was over here, you were not thinking trading range, you were thinking trend. And at this point, it was a trend. But when you look back, you can say, yes, it was a trend, but it ended up as a bull leg in a trading range. So it was a trend and it was also a trading range, but only in hindsight. That is the end of my module on trading swings in the middle of the day.